Hello, everybody. Welcome to the Build Weekly Roundup. It's the year 2025, week 27, but most importantly, it's July 3rd, the day before our Independence Day. I'm Dave Martin, and with me is Matt Dines. Cameron Otsuka is out celebrating, I think, a wedding and the holiday, so it'll just be us today. Today, we're going to have a little bit more focused of a rip. The headline is that the US dollar, has had its worst start to a year since 1973. And Matt is here to walk you through his thoughts on what's going on, what are the implications, and probably most importantly, what are the shoes we should be expecting or watching for to drop in Q3 of 2025. So Matt, walk us through this. I mean, this is a splashy headline. What's going on?
Yeah, so just to see that year, 1973, right? That was a kind of coming off of a very important year in the dollar, right? We know 1971, Nixon, um, say removed the dollar off of the Bretton Woods, the last vestiges of Bretton Woods, kind of currency protocol by removing the redeemability of dollars for gold. Now, that redeemability was only for like large nation states, like central bank to central bank um, redemptions. But that closure of the dollar was basically the end of an era from, let's say, 1933 with Executive Order 6102, which was technically also kind of a forced migration of the dollar as a currency within the US economy from gold and onto a silver standard. And that gradually eroded from 1933 to 1971. Um, and then 1973, just to put this in big historical context, that was when you saw the kind of famous Nixon Kissinger interactions with China, and kind of set in place a kind of a business agreement between those two economies that really laid the groundwork for international trade in the dollar standard, if you will, that we've been operating under from 1973 to present day, right? So what if you take that view, zoom out, and you look for the signal amidst all the noise and the chaos, you can see kind of a renegotiation of that framework going on. So I think that's the big focus of our topic today. You'll hear these narratives like, oh, de-dollarization, death of the dollar. I think I'll walk through a little bit here, make some sense, hopefully, out of the core trends that we've been seeing in half one of 2025. It's a good time to look back and review now that we've crossed that halfway point of the year. But hopefully it'll make sense what's going on in terms of kind of a change of state, if you will, a state change, to put this in like chemical reaction type terms, with the dollar, international trade, and kind of these big picture, big business agreements in place between, just these multipolar blocks that represent distinct, civilizations as they interact with each other. So, Dave, you want to
Yep, got that.
transition? We'll go to the DXY
Yep.
chart, which is really the straw that's stirring the drink in capital markets right now. As opposed to the last, 40, 50 years, if you're a financial advisor, you only need to pay attention to that upper layer of, let's say, stocks and bonds, and you can do the 60/40 and, that sliding scale, dial up, dial down based on age, risk tolerance, etc. What's going on now with the dollar is kind of underneath the hood, um, becoming, in my opinion, extremely important. And if we are in one of these state changes, like 1971 to 1973, you've got to get this right. So I'll just illustrate here, and then we'll walk through the actual uh, kind of trade pathways or chains that'll hopefully make sense of what's going on with the dollar, gold, etc., and then also these trade agreements, how this all kind of fits into place. And they're all essentially the same story. It's a currency uh, transition or redefinition. So this is the dollar chart. I've zoomed out to the post or the 2008, GFC, so we can see that on the kind of the left-hand edge of the chart. And what you'll see is the dollar has been in a, you can call this a long term for some, but 15 years, that's roughly, that's a good chunk of a human lifetime. To us, that feels like long term. But in the context of these big picture kind of agreements, 15 years is, maybe medium or short term even. But we've operated for 50, we talked about like July 4th, right? We're on year 249, about to be in 250 years for the history of the US. So, um, in human civilization terms, 250 years is nothing, right? Like EU has been around since, really the advance of Rome, starting, uh, 700 BC, stuff like that. So 3 millennia for that civilization. Uh, China as a civilization has been around for like 5,000 years. So in the grand scheme of things, the dollar in the U.S. This is we don't think of it as like the blink of an eye, but if you zoom out, you read history in terms of human civ, all these things happening. This is but a moment in time, right? Even 15 years. But what we've seen is dollar has been in an uptrend, and we've tested the support on that channel now 3 times after this week during that 15 years. So the first came in 2011 with the EU sovereign debt crisis. This is the PIGS, Portugal, Italy, Greece, Spain situation. We also tested in late 2020, 2021, the second red arrow with the COVID just liquidity injection. Um, and then we tested it this week. Okay, so we're back at the bottom of the channel, and this is a make or break point. You're either going to break down from here, and this could happen in the coming, it could happen next week, it could happen 2 years from now. It may not. It may go the other way, and the Bulls win back that channel. But this is what we're looking at right now. So the dollar is in, like what it's telling you is we're in a very important place right now for the big picture of what's going on. So hold that thought in your head, and then you see just the slope over the course of 2025 year to date, right? Ever since basically this new Trump administration took office on January 20, dollar has been on a very steep descent line, and gets back to that New York Times headline we showed on the last slide. Dollar has its worst start to a year since 1973. This is a very sharp, accelerated trend, right? So we're heading into that channel. And we're at a point right now where it's essentially like make or break in terms of which side is going to win out on this trade. So when I say this trade, I think the next step is like, what do we exactly mean by this? Why is the dollar weak? Is it because of tariffs? You see some articles saying, hey, economists thought tariffs should strengthen the dollar. They've been dead wrong. What's actually going on? So Dave, if you want to go to the next slide, this is kind of the heart of the story. It's the other side of the coin of what's going on with that weak dollar. So you've probably seen headlines about record physical gold deliveries coming into the U.S., right? And this is just one chart of Swiss gold imports. And this was, the data's only through like February on this chart. But the Bloomberg article is citing that gold imports from Switzerland into the U.S. were up 3x from April to November. You start to think, what's going on here? What's the driver? And it's not just Switzerland. If you zoom out and you look at the trade data where imports are coming from, there's a specific category. They call it like metal shapes or shaped metals. And you see that number going up, right? So something's going on.
And these are, to be clear, these are goods imports, right? These are things that the U.S. These are all items that we're importing from Switzerland. But there's the story behind it is gold. Am I reading this correctly?
Yeah. Yeah, I think if you yeah, I would agree. I mean, there are some people who think gold is a relic of the past, but in terms of the monetary battle, what you see going on, as I walk you through the trade there, this isn't a friendly move, right? You don't, this is like foreclosing on your neighbor if you lent him your mortgage, like if you lent him money for his home mortgage, right? It's not a, it's not a friendly move. So this is, you could say it's a good thing, right? From the U.S. perspective, I think undoubtedly, like it's hard to argue it is. Like, think about imports coming into the U.S. ports on a shipping container, right? From 1980 to let's say 2020, your shipping container was probably filled with just a bunch of junk. Uh, I mean, some of it was, nice stuff, iPhones, you know, consumer electronics, 150-inch HD TVs for $300 that you get at Walmart, tube sock, like all of that
Sure.
stuff, right? But there was a lot of just crap. Now, what you're saying is those shipping containers, those airplanes, they're filled up with gold. So we're actually taking back real property now. So there's a new regime in town. I think if it wasn't clear to people, the United States after the November election is under new management, and like what you're seeing now is kind of a renegotiation of all of those deals. Establishing a framework for terms of trade, order of business, financial relationships between the U.S. and the rest of the world. So this is your smoking gun. Now, how can that be? I've laid it out in the next slide with an example payment chain um, of how this materializes. So if you start here, this is how financial transactions work. Somewhat complicated when you go cross border, but I hope I've simplified it in this chart. So got a four-step series of events. I'll walk you through exactly why we've seen the trends we have in the dollar, like weakening of the dollar, strengthening of the euro, and rally in gold prices over the last, let's say, I mean, gold's been in a rally for, you could say, zoom back to the bottoming and roughly September 11th, 2001 is where it would equate, more or less. But gold has been in a strong rally, if you look back on a 10-year window or even on a, 18 to 24 month window. But this will kind of illustrate with an example of trades between financial intermediaries, like what is going on. So step one, follow with me here. Dave, ask questions if you have, because I'm sure the audience would benefit
Yep.
from some slowdown. But let's start with a U.S. bank based in New York, right, where most of the capital base sits in the U.S. Let's say a U.S. bank lends its, foreign subsidiary, say it's got a sub office in London, and it wants to send USD to that kind of subsidiary organization, right? You could lend it, you could send it a deposit, like whatever transaction. There's multiple ways you can make this happen. But let's say the U.S. just sends a deposit or makes an intercompany loan to a branch office in London. All right. Now you're sitting on that New York home office is sitting on kind of an IOU or a deposit, and the branch office is London is sitting on sorry, branch office in London is sitting on like the hard dollar deposit, right? Now, second transaction, let's say that subsidiary bank branch from the US goes into the foreign exchange market and wants to sell those dollars for euro. I'd argue that's exactly what's happening with the weak dollar, right? So your counterparty
And
who's buying the
Matt, they're
euro.
doing this. They're not doing this for. Are they doing this for lending operations? Or are they just doing it like FX trade?
But step two would be an FX
Okay.
trade. You're trading dollar deposits for euro deposits in the spot market.
Yeah.
But like in this whole grand scheme of things, like debt and IOUs is part of the picture as well. We'll just simplify, but you do have to have spot market FX
Yeah.
transactions here to get the hard currency to buy what you want to buy. And we'll go to step three. You're going to go
Right.
shopping. You got to buy something. You need hard currency. You need
Yep.
money, not debt.
Yep.
So step two, that US bank branch in London goes into the FX market. It sells its dollars that it got from its home branch in the US or back in New York, and it buys euro. Now, who is your counterparty on that? It's probably a European bank, right? It's going to be, let's say it's a bank in Madrid,
Yep.
BBB, like that. It could be anywhere in Europe, in the EU. It's bidding dollars, and what you're seeing here with that downward pressure on the USD, that bid is just relentlessly getting hit, right? Um, why does the European bank keep bidding dollars, despite getting hammered? Well, over the course of 50, 60 years on this offshore dollar, there's been so much dollar debt created. Um, they have to have, like, at some point, there's always going to be a bid for dollars. It's not like if this went the other way around and Europe, like a European bank was trying to run this on the US, there's not much euro denominated debt sitting inside like the US economy. Like offshore euro denominated debt isn't nearly as popular as a holding as is offshore dollar debt, right? So that because of the structure of the last 70 years in the buildup of the offshore dollar post World War II, this can happen, right? So there's a liquidity pool to absorb these dollars, despite the relentless, selling of dollars for euro. Now, your foreign branch bank office, they probably really don't want euro. What they're, maybe there's something there. Obviously, we know there's going to be a spin up. Um, in the last 6 months under the new Trump administration, um, there has been kind of an agreement that's finally arrived at between the NATO powers. Like the European countries are going to increase their share of GDP that's going into military funding. That's going to lead to credit creation in the EU. So there will be nominal growth in the EU. So maybe these banks do want to hold some euro to tap into that growth. But by and
Yep.
large, what else are they doing? They're doing this step three in this transaction chain. That bank is going to take those euros and buy gold. So essentially they're selling those euro
Yep.
deposits and buying physical gold. They're taking physical delivery, and I put the vault here in Switzerland, just because that chart we showed on the prior slide. Physical delivery is coming from Switzerland. It's coming from everywhere though. Like you're running this trade if you're a U.S. capital, you're running it against any vault in the EU. So it's hitting the pound, it's hitting vaults within Europe, it's hitting Swiss gold vaults, and then what you do is step four, the U.S. bank. It doesn't have to be a bank. This could be a hedge fund, any other financial institution who's taking part on this. But it makes sense for a bank because they have that Fed discount window, the access to dollar deposits. It's much more frictionless and less risk because of your backstop to the lender of last resort, and you have Federal Reserve settlement available to minimize counterparty risk. It's much easier, or it's much lower risk to do this if you're a bank, right? So then step four, the bank takes physical delivery of the gold. Comes over in a Boeing 787, comes over maybe a ship, probably more likely the airplane these days. But this is like 1940s cash and carry, where US was going to supply Europe to arm for fighting in World War II, and there was some element of that in World War I as well. But the direction of the physical gold is moving towards the US. So this weakening dollar, there's, some interested parties, are making that happen. This is just one illustration of a trade that's behind that trend we're seeing, but it's kind of like a very popular one. So if you make sense of what's happening, this death of the dollar narrative, right? Just pause right here and think about what's going on. EU, we're forcing them to take a glut of dollars, right? We're like foie gras stuffing their banks with dollars, and we're making a run on their gold vaults, right? So we're taking the hard money and stuffing them with paper
And
money,
this,
right?
Matt, this reminds me. You've heard of Gresham's law, right?
Yeah, yes.
Bad money drives out good. If depending on how you view the flow chart here, you could say, yeah, you could the if we look at the U.S. dollar as bad money, that's a loaded statement. But the bad money is flowing into Europe, and the good money, the hard money, gold, is flowing out. Is that the way you interpret it?
You could, it's not a pure, like when, once you get like precise into Gresham's
Yeah.
law and what you're getting at, like that was a very specific kind of arbitrage when you're on trying to manage a dual pegged bimetallic standard. So it's like gold, silver. But I think like what you're seeing now, like we've lost and this is a story that's been in progression since the entire existence of the United States, right? How you start off the dollar. I don't want to go back to 250 years and overcomplicate this, but yeah, it's essentially like what you're losing here is the paper claim on the dollar against the bimetallic standard, both gold. It's also in silver, and we'll get. I didn't get into that as much this year, but you can see the metals rallying, right? But yeah, Gresham's law is maybe a good simplification, but it's kind of like an expansion on that.
Right.
Would be how I'd lay it out. But yeah, that's exactly what's happening. We're force feeding these paper claims onto and running on like the hard asset. And you can run this playbook. It's working through gold. It's working through Nasdaq, as we'll show later. Could be working through Bitcoin. I don't illustrate that here, but you could run this. You know that this is capital wars, right?
Yeah.
So this is what's going on. Eventually, what you have to do as a bank, you cannot declare yourself like. Eventually, you have to shut off your gold redemption window.
Yeah.
You can do that, which is kind of a notice to the world that you're insolvent. You would rather not do that. What you have to do to defend against this attack, if you're on the weak side, eventually you're going to have to do like a closure of your capital account. Is where this goes. So this is actually, I call it a capital war. Like this is like a key battlefront as nation states or these regional multipolar blocks, interact with each other. And it's kind of a who blinks last, right? Who has the longest straw to hold out to outrun like the the pressure, outlast the pressure, and come to the table on these international trade agreements to accept terms. So what's going on here? U.S. can run this primarily because it has the dollar deposits. It doesn't have to print while it holds interest rates high. So you see this element of there's like inter nation or intercompany squabbles, if you could think about it, within the U.S. as one big business between the Federal Reserve and the Treasury, right? Federal Reserve wants to keep short-term interest rates high because you can keep doing this, right? If you keep interest rates, if the U.S. short-term interest rates are at 4%, SOFR at 4.3 and change, and there's no spasms occurring in the overnight funding markets that you need to address and immediately ease. If you can hold interest rates high at 4, you can pull in deposits from the rest of the world, right? And so far, you've already seen with U.S. interest rates what we did in the 2018 hiking cycle. We already brought London to heel. They've absorbed and come onto SOFR. Like that was winning. That was bringing your opponent to heel, or maybe your opponent isn't the right word for it. It's your could be your partner, right? But you've brought them into the fold, and you know who's in charge, right? So that SOFR London migration, that was one step of like exercising U.S. authority through the capital wars. Now on the other front, you've got another short-term deposit, dollar pegged or pseudo dollar denominated overnight funding rate in Hong Kong with HIBOR. And so that differential right now for the Southeast Asian dollar capital centers, especially as it relates to China, HIBOR is at 2 bips right now. They've had to cut to zero after what we saw happen with Liberation Day. HIBOR at 2 bips, New York at 4% with SOFR, able to hold up, is pulling dollar deposits away from the Southeast Asian monetary base. So you're seeing the drainage from the rest of the world. What we're getting is this is working for everybody in DC and New York. You're seeing an accumulation of dollar deposits, and this shows up in the Fed H.8 data, as we've talked about in prior weeks episodes, Cameron and I. And you're also just running gold. You're increasing your gold stocks that are coming into your inventories in New York. And the further now, if you run up your gold price and you're getting more ounces of gold, that's your base layer collateral for the credit in your economy. And then to keep things going, like make sure the US economy holds up, what is it dependent on? Credit creation, right? So this is the capital war that's part of the bigger picture kind of interpower conflict that we've really seen. You could say it got underway in 9/11. I call like the start point here, but really got underway in 2008, and it's accelerating now towards some next step, right? This may go on for a long time. Like these, World War I, World War II. If you think about those as the same two steps of the same conflict, the international powers reset, that was like 30 years, 40 years. Like these things can last for multiple decades. So if you start the clock at 9/11, we're 20 years plus into it. This could be the next. There could be 10 to 20 more years before we come to a reset of consensus. All right, now this gets to interest rates, right, and currencies. So you see in the light blue, I've got the Swiss franc. And so this is actually Swiss francs per dollar. So down on the blue chart is actually strengthening of the Swiss franc or weakening of the dollar. And then up would be a stronger dollar, weaker Swiss franc, right? And then in the white, on the background is your overnight repo rates. This would be like your SOFR, right? Or what we used to think of as LIBOR, right? LIBOR's dead. But in Switzerland, what you've seen now, unless you close your capital account and end the run on gold, the only thing you can do to try to defend yourself as your first step is lower interest rates. And this is what you've seen in overnight funding markets. Swiss overnight rates, despite the last hiking cycle from 2022, which is it ended in first quarter of 2024 for Switzerland, and now it's back to negative. It's at negative 4 bips as of this morning. Their hike cycle's very clearly dead in the water. They're forced into this position of weakness, which is negative interest rates. They were able to get their negative rates as low as 75 bips, negative 75 bips. So there could still be, further pain that they're willing to absorb. But this is your first step. It's kind of the thing, like the beatings will continue until morale improves, like to put a dark spin on this. But you're going to eventually have to find some other way to resist this. I guess you'd call it an assault almost. Like someone's running on your gold. You're going to need to find a way to defend yourself. And negative rates may be the first step, but it's not. In the long term, it's not going to work. So.
How long can in general though, like how long can an economy? I don't know a ton about the Swiss economy. How long can an economy go with negative rates? Because on this chart, it's 7 years, 6.5 years from 2015 to basically until the Fed started raising rates, right? So what? I
Yeah,
mean, this doesn't seem sustainable, right?
it's not. And it's like, if you think about it, you set up like 6 years and maybe a little more of running your short-term rates at negative 75 bips. Think about what was happening to your G-SIBs that were like the Swiss kind of representation in global capital. It's UBS and Credit Suisse. What were you seeing out of Credit Suisse at that time frame? Like, you put what you're actually doing by running negative rates, especially negative 75, you're putting your G-SIBs in a position of weakness, right? And 6 years, what they're going to actually end up doing is, they're at a disadvantage in capital markets. Like, you're getting a run on your gold, your hard assets. Um, your business is basically getting, stolen. If this is a turf war, in a city, like, you're losing city blocks.
Yeah.
And so what you saw Credit Suisse doing for 6 years, like Greensill, what were the other ones? Bill Huang's, what was his? Help me
Oh,
remember your
Archegos. Yeah.
Archegos, Wirecard. Like,
Yeah.
you're involved, like, you get stuffed with some garbage, and then what happens? Like, while you're in that cycle, your bankers are trying to go out, make deals, make a buck, or make a franc, if you will. It gets harder and harder. And then once the next part of the cycle comes, you're weak, and vulnerable. And that's exactly what happened with Credit Suisse as the rate hike started coming in. You know, they could only withstand 1 year. It was 4 quarters, and then the biggest scalp that was taken in that 2023 kind of banking blow up. Like in the U.S., we think about the names, and the largest among them was First Republic. But globally, amongst the G-SIBs, the only G-SIB lost was Credit Suisse. So you're just showing up, weaker and weaker in this global capital war. And eventually you're going to have to do something, and I'll get to what that is kind of in the last slide, what we should accept. You could also accept defeat by, signing a trade deal that gives better terms to, the other side across the table from you.
Yeah.
But no one wants to do that, because those trade deals, once they're done, once you lock in a new financial order, merchant banking, agrees upon interactions, those will last for decades, generations. So you want to hold on. Like, this is something you fight like tooth and nail for until you're forced to capitulate.
Yeah.
It's like a war, but the treaty won't be signed on the USS Missouri after, two atomic bombs are dropped on Japan. It's like the treaty will be signed in, Geneva with, banking trade agreements, which is like what we've been seeing with all these meetings in Geneva, London, etc., is how it resolves. All right. So you see this gap is only moving one way. I show it, like, the gold divergence is the key here. If you want to make this stop, you've got to close this gap where the U.S. is running up the price of gold in dollar terms versus euro terms. They're not able to keep up, right? And so since the telltale chart here is this divergence between the red line is the U.S. dollar based price of gold, and the blue line is EU. And if you looked at Swiss franc, it might even be more. But at this point, since the UK pensions snapped to set the end of the hiking cycle, if you will, for the Fed's last play from 2022, or March 22 up to September, where it started slowing down the pace of hikes. You've seen the gold price in terms of spot markets. The divergence between the U.S. and EU now is over 30%, right? In not even is it 3 years? Like, yeah, we're not even on 3 full years yet. So this will continue until someone kind of cries uncle and taps out of the fight. And it's also, the gold mechanism for those trade flows. That's been going on since the Biden administration, right? The Fed, the U.S. banks, U.S. capital, they've been under the same page for 3 years running this playbook. But if you think about what's happened in the NASDAQ itself, you see this same thing start appearing in the US, large cap Mag 7s. If you think about it, now it's all starting to make sense if you go back to those 2010s headlines where the Swiss National Bank was actually accumulating your Mag 7 shit, like some of them, Google, Apple, etc. Your large tech companies, your hyper scaling compounders. What you're seeing now, after you had a change of administration from Biden to Trump 2.0, now you have an executive branch that's aligned with the playbook that the U.S. capital out of New York has been running for 3 years. Now the White House has joined in, and it starts to show up not just in gold, it's in NASDAQ as well. So if you look at talk about the gold divergence on the last slide, it's on triple Qs as well. The Spider NASDAQ 100 ETF. You've seen so far this year, if you look at your NASDAQ return in dollar denominated kind of measurement, from a U.S. investor's perspective, you're up 8.8% year to date, versus if you're a Euro, an EU-based investor measuring your returns in a Euro-denominated, investment fund, you're down over 4% on these holdings. So this same playbook, it's working its way through. Like, what's going to happen if you keep running this playbook, right? These series of trades didn't map this out for everybody, but what it's also doing is it's driving your EU equity markets higher. You see that in the German DAX, you see it in Spain. You see it very strongly in Poland. Like it's pretty much across the board. And what are you going to do if you're an allocator, whether you're retail or an institutional allocator? You're going to buy more of what's working, where you're getting positive returns, positive trend. You're going to sell what you don't. So your quarterly allocations, what you're going to end up doing is you're going to sell U.S. equity, buy European stocks. That's the same thing as gold. You're essentially bleeding shares of U.S. large cap tech back to the U.S. is what's going on here.
I mean, this in a way we talked a few months ago about the European Commission, and they're trying to unlock savings, like retail savings across the Eurozone to spur investment. And
yep.
If you think about how investing psychology works, people do go on momentum, so they see their stock markets pumping, and that encourages people to get off the sidelines. Oh boy, look at this rally! Like, yeah, I got to get in on this. So, do you see this playing into? I mean, I guess it's a strategy on their part. They need to boost domestic and in the Eurozone investing and get people off the sidelines. Is this actually helping them do that?
Yeah, you need. So if this is the nation state model, and you're facing like you're getting called on your capital, like you're getting margin called, everything, to stop the bleeding. What you could do is say you're going to freeze your capital accounts, or you close your capital account, or close your gold delivery window. You don't want to do that, though. That's an extreme sign of weakness, and at that point, like, you're admitting.
You'll get flight. You'll actually have population flight at that point. We've seen it in history.
And you're also seeing this too. You're seeing exactly that, like the millionaire exodus from the UK. Like, they're moving to, like, number one destination is Dubai, number two, maybe US. But yeah, you're seeing that capital flight, especially out of London. But if you want to, like, you don't want to make that declaration that you're closing your gold window or you're closing your capital accounts. Like, that's like I get the U.S. did exactly that in 1971 or close to it. They closed the gold window, but they opened the capital account, and it actually worked. Like you ran, well, it worked, but you had to just abuse the dollar for a decade in the 70s, like to get through that. And then from 1980 to 2020, you could say it worked. But like if you do these measures, there's gonna be pain, right? So you want to find a roundabout way to do it. And one of the ways that's, historically been done, and the U.S. has done this too on you know, the, the, the bimetallic gold and silver standard. Like one thing you've seen the U.S. do a couple of times is debase against the silver standard, but they'll do it only for like small denominations. Like I think it was like in the 1800s, late 1800s, they had a couple times where they had like a trade dollar, right, where it was still silver denominated, but they lower the weight of silver per dollar, unit of coin. But it's only for denominations up to $5, right? So who actually gets rinsed? It's your captive, working class audience, or population, citizenry. Like they will put the tab on the public if they can.
As they can't move to Dubai, they can't move
Yeah,
to the US.
yeah, exactly. They can't afford to, yeah, exactly, do all of that process or move. So who are you going to ultimately rinse? It's the savings of the German working class, the Italians, the French, but like that's the next step. And that's where you get into our last slide today.
Yeah.
The ECB and the euro are, if this continues, unless you want to keep bleeding gold, you will see a currency action incoming, out of necessity. And this is where the telegraphing we've seen from Brussels lawmakers talking about this digital euro, or the savings and investment union. This is what's going on. You've got to find someone to debase, and it's going to be your EU residents. There's going to be credit creation on top of that, so it'll look like nominal growth. But this is kind of the perspective. Like EU is going to be forced into doing these things. So when you hear these headlines that talk about the dollar, the de-dollarization, the worst decade for the dollar since 1973, paradoxically, you're able at this point to execute that playbook to weaken the dollar out of strength, right? And none of these fiat currencies are quote unquote like strong. It's just a matter of who has the longest rope, who can outlast the others and win concessions in these trade agreements, which is ultimately what it's all about. It's trade flows, settlement, and owning kind of the monetary layer that those new interactions will take place for the century ahead. So if you think about it, all these headlines, they look terrible for the dollar. You can go out, protest Trump, call Scott Bessent an idiot, look how badly we're doing. But if you think about it, what is it actually showing if you're able to run the European continent on its gold and also run Southeast Asia and in particular Hong Kong out of its dollars? I question those narratives. This is a time of intense upheaval. There's going to be a lot of volatility up ahead, but this is think about there are no winners in war, right? But if you think about who is this good for, if you will, and I say like good is not. The ideal thing would be for cooperation and growth and trade agreements, etc.
Maybe advantageous is a word.
Advantageous in the tug of war, I'd argue it's much better for the U.S. Than it is for the rest of the rest of the world. Now, what is your throttle if you're the U.S.? If you want to, when do you know when you have to stop running this playbook, weakening your dollar? And this goes back, Dave, if you want to go to like slide 2 where we have the dollar on the chart.
Yep.
When do you have to cry uncle? it's once you start seeing, what we've given a misnomer, price inflation in the U.S. Once you see price levels rising, consumers, American workers, once they see those dollars that you're paying them in their wages debasing at an accelerating or a heightened rate, that's when you have to stop. So this is when, like, if you're looking at the CPI prints, what's going on in that data, that's your signal for, all right, if inflation stays tame, US can keep running this playbook, and I've labeled in terms of the flags on the map. US wants to actually break channel lower, if they can, and it all amounts to holding up CPI and jobs and nominal GDP growth, all of that inside the US. If you're the EU, you want this attack to stop. You want to bounce the dollar back into this green, parallelogram I drew on the chart, get back into the post-2008 channel. But which position would you rather be in here? Undoubtedly the US. And then, like, last comment, didn't go deep on this, but what stops this trend? As we said, it's CPI, price levels. The core problem the U.S. has is these 100% import dependency rare earth metals, right? If you think about the 21st century goods, right? Cybersecurity, drones, electrification, all of that. You need these rare earths, these magnets. You need metals to build this out. That's the limiting function.
Yep.
Some of this stuff U.S. can get from its own, continental 48, Alaska. This is where Canada's natural resources come into play, and why you're seeing such a. You think about the comments between, Trump and the Canadian politicians about 51st state, that resistance. It's about natural resources, and in particular metals, right?
And these are durable trends. These are, like you said, these are durable 21st century trends. Like these things are not going to go away.
Exactly. So all of this needs to be renegotiated. China's sitting on, like, its biggest trump card it's holding is it's a core producer of the majority, like, of these 100% import dependency metals. So U.S. wants to make a deal with China, like it needs to. There's some of these rare earths that we could develop, deposits into production, but that's going to take years. It's going to be dirty. You would rather outsource that if you can. China wants to hold out, and their statements over the first half of this year that they're not going to export rare earths. They're going to take those core inputs and manufacture up the value chain themselves into drones or other 21st century goods, and they're going to export the finished product and take on more of the value capture within the Chinese economy itself. And this is where you see kind of makes sense now that China is the leader in drones, right? DJI, these human robotics, like all of that. It's all starting to make sense. Who's important here? But when you think about, like, who's bringing nothing to the table here? Who brings a knife to the gunfight? Well, U.S. clearly has stuff like that's valuable in the 21st century context, and we're running the gold, right? And you see this from China as well. It's leaned heavily into gold. So there's a deal to be done here between the U.S. and China. We'll come to some agreement, in my opinion. I'm still hopeful on that.
Yep.
I think that's where this ends. But where do you not want to be? I would, if I'm choosing in the draft who I get to be first, I don't want to have that draft pick where I'm forced to take the EU in my perspective here. Others may differ. But that's my color commentary on what's going on. We'll continue watching in Q2. Expect some big headlines to drop.
Q3.
There will be Q3. Sorry. Thanks, Dave. There will be those big headlines that come out in terms of If it bleeds, it leads, right? U.S. dropping some bunker busters on Iran is going to capture everybody's attention, whereas, say the ECB launches some sort of uh, digital euro that lets them financially repress their citizenry, that'll be suppressed, right? So it'll come under the fold. Expect that to come with market volatility as well. But I think the key thing, if you're watching, watch what happens in the dollar. This is that window of it's either going to snap back into that channel, or you're going to see kind of a state change if we break below it. So we'll see which path we take as this big historical transition that we're living to goes into its next state.
Yep.
Next state change.
And for those at home who don't have a Bloomberg terminal, if you want to follow along the dollar, just Google DXY index, and you get data on you get charts on MarketWatch, on TradingView, all for free. So that's the thing you want to be watching. Well, Matt, thank you for this deep dive. I hope everyone out there has a wonderful 4th of July celebrating America's independence. Let somebody else light your fireworks. Stay out of the emergency room. Stay safe. Have fun. Touch some grass this weekend. Have some hot dogs and enjoy it with your family. And we'll be back at it next week. So thanks again, Matt, and we'll see you all soon.
Happy 4th of July, everybody. God bless America.